Welcome to the Money Mindset Podcast. Here we break down finance, investing, and smart money strategies in a simple way.
Right now, the United States government is spending more money simply paying the interest on its past debt than it spends on the entire national military.
Yeah, which is just a staggering statistic.
It is. It's a mathematical doom loop. And in response to that reality, the smartest money in the world is fleeing the traditional system. They are rushing toward two absolute extremes.
Right, 5,000-year-old rocks and lines of computer code.
Exactly. Welcome to another deep dive. Today, we are looking at a 2025 financial landscape that is just tearing up the old playbooks.
Completely.
Bitcoin is absolutely smashing past $100,000, even touching $120,000 at times. And over in the physical world, gold is flirting with a record $4,000 an ounce.
It's a wild time to be watching the markets, you know?
It really is. So we've pulled together a stack of wealth management reports, market analyses from JP Morgan, Goldman Sachs, Standard Chartered, and some deep dive crypto blogs.
To answer one really mission critical question.
Yes. In a world of structural economic uncertainty, which of these is the true safe haven for your money? Okay, let's unpack this.
Well, to evaluate a safe haven, we first have to look closely at the storm that, capital is fleeing from.
Right.
You don't just abandon the US dollar unless the structural integrity of the fiat system is under severe pressure. And in 2025, that pressure is coming straight from the top down.
Oh, absolutely. I mean, the Congressional Budget Office is forecasting a $1.9 trillion deficit for this fiscal year alone.
Yeah, and a deficit of that magnitude, it isn't just a temporary accounting gap.
No.
It alters the fundamental machinery of the economy. When a government spends $1.9 trillion more than it collects in taxes, the Treasury has to issue bonds to cover that difference.
But there isn't enough organic demand in the open market to absorb that much debt at sustainable interest rates, right?
Exactly, which forces the Federal Reserve to step in. They ultimately have to create new bank reserves to absorb that debt.
Basically printing new money to finance government spending.
Right. We're looking at a structural cycle of debt monetization.
Yeah.
And every time that happens, the purchasing power of every single existing dollar is diluted.
And the cost of carrying this accumulated debt has crossed this terrifying threshold. We mentioned it at the top, but the net interest payments on the U.S. national debt now sit at 14% of the entire federal budget.
Well, national defense spending is at 13%.
It's crazy.
The broader economic implications of that crossover are profound. I mean, the term economists use is the crowding out effect.
Right.
The economy's capacity for productive growth is essentially being hollowed out. Capital that could be building infrastructure or funding research or expanding businesses, it's being drained just to service legacy obligations.
It's the sovereign equivalent of a friend who is buried so deep in debt that they have to open a brand new credit card just to make the minimum interest payments on 3 other maxed out credit cards.
That is exactly what it is.
Yeah.
And eventually the math stops mathing.
It has to. And this domestic financial pressure is colliding head-on with a massive web of global friction. We're tracking the economic ripple effects from the early days of the Trump presidency, ongoing trade war tensions, and the profound market shifts surrounding the U.S.-Iran conflict and the subsequent peace developments.
Right.
And wait, let me just jump in quickly. I want to be super clear to you listening. We are not taking any political sides here.
No, not at all.
We are simply impartially reporting the economic drivers that are mentioned in these source materials.
Exactly. We're looking strictly at the mechanics of these events, how capital flows in response to tariffs or sanctions or shifting treaties.
Right.
The market reaction to this combination of deficit spending and geopolitical friction is a structural debasement of the US dollar. Institutional investors see supply chains being weaponized, debt spiraling, and they price in a weaker currency.
And the Federal Reserve's ability to defend the dollar is heavily constrained right now. We recently saw a record-breaking downward revision in the U.S. labor market.
Yeah, erasing 910,000 jobs from previous estimates.
910,000. So the underlying economy is much weaker than the initial headline number suggested.
Which locks the Fed into an interest rate cutting regime.
Right.
Their dual mandate requires them to stimulate a weakening labor market by keeping the cost of borrowing cheap. But, when you cut the federal funds rate, the yield on U.S. Treasuries drops.
So if you're an investor or a sovereign nation holding billions in U.S. reserves, you're watching inflation eat away your purchasing power while your treasury yields fall?
Yeah, you are losing money in real terms.
And that mathematical reality forces capital to seek alternatives completely outside the fiat system. So if the dollar is losing its purchasing power, where does the smart money actually go?
Well, for the last 5,000 years, the default exit door from a devaluing currency has been gold.
The heavy hitter.
Right, because if we connect this to the bigger picture, gold sits completely outside the modern cycle of debt monetization. It carries zero counterparty risk.
Explain that counterparty risk part.
So a U.S. Treasury bond is essentially a promise from a government to pay you back in the future. If geopolitics fracture, that promise could be sanctioned, it could be frozen, or paid back in heavily debased currency.
Ah, I see.
But a bar of gold in a vault in Singapore simply exists. It doesn't rely on a promise.
And the performance numbers in late 2025 really reflect that flight to safety. Gold has been on an absolute tear. It's up 37.4% year to date.
Which is massive for gold.
It is. And in that exact same specific window, Bitcoin is only up 18.7%. So the heavyweight champion in the world is really flexing its dominance right now.
Definitely. But this massive surge, it isn't being driven by retail investors buying coins at the local pawn shop.
No, it's way bigger than that.
It is being driven by a coordinated accumulation at the highest levels of global finance. Central banks around the world are actively dumping U.S. dollars and buying physical gold at a historic pace.
Wow.
We're rapidly approaching a monumental tipping point where foreign central banks will hold more physical gold in their reserves than they hold in U.S. treasuries.
Wait, really? Yeah. When the institutions that literally issue fiat currency decide they would rather hold a physical metal than another nation's debt, that is a massive signal of de-dollarization.
Exactly. They are losing faith in the paper system.
And Wall Street sees this momentum accelerating. The reports show Goldman Sachs has raised its end of 2025 forecast to $3,700 an ounce, with a bull case modeling $3,880 if a U.S. recession hits.
Because gold thrives on institutional uncertainty.
Right. But wait, let me push back on this a little bit.
Sure.
Isn't gold scarcity kind of a pseudo-scarcity?
How so?
Well, the sources mention that new veins of gold are discovered all the time. Doesn't that mean supply isn't actually fixed?
That's a great point. You're right. We talk about its scarcity like it's a law of physics, but it's really an economic elasticity.
Right.
Gold is rare in the Earth's crust, but as the price rockets toward $4,000 an ounce, the profit margins for mining companies explode.
Right, so it incentivizes them to deploy more capital, dig deeper shafts, and extract lower grade ore that wasn't previously viable to mine.
Exactly. So the supply isn't actually capped. It inflates by a couple of percent every single year based on human effort and technological advancement.
So if you want true scarcity,
that mechanism exposes the fundamental limitation of any physical commodity. You can always pull more out of the ground if you throw enough capital at the problem.
Right.
If an investor wants an asset with absolute mathematically guaranteed scarcity, they have to look outside the physical world.
They have to look at the code, which pivots us perfectly to the digital challenger. Bitcoin is built on a hard cap of 21 million coins.
Right.
And based on the protocol, the last fraction of a Bitcoin is projected to be fully mined somewhere around the year 2140.
And the way that cap is enforced is what makes the asset functionally unique. There's no corporate board, no central bank governor who can decide to just alter the supply schedule.
No one can print more.
Exactly. 21 million limit is enforced by a decentralized network of tens of thousands of independent nodes running the software globally. For the supply cap to change, an attacker would have to convince the majority of the network to voluntarily devalue their own holdings, which completely contradicts basic game theory.
And that enforced digital scarcity has driven a massive maturation phase for Bitcoin in 2025. It surged 20% after an April low, broke the $100,000 barrier, and even traded above $120,000.
Yeah, the numbers are huge.
But the most revealing detail in these reports isn't the price tag. It's the shift in how the asset is behaving. The sources note Bitcoin is starting to trade in line with gold rather than tech stocks.
That is a massive behavioral shift. Historically, Bitcoin traded with a high beta to the Nasdaq-Q. It behaved like a speculative, high-risk tech stock.
Right, when liquidity dried up, Bitcoin sold off aggressively.
Exactly. But we are seeing a distinct shift in market behavior this year. It's acting less like a tech bet and more like a macro asset responding to monetary debasement.
And the institutional explosion backing that shift is staggering. BlackRock's ETF logged massive inflows. One source cited a staggering $442.1 billion net inflow figure.
That is a lot of capital.
And corporations like MicroStrategy now hold $78 billion in Bitcoin on their balance sheet.
Yeah. And on top of that, regulatory tailwinds are really clearing the path.
Oh, like the Genius Act.
Right, the Genius Act advancing in the Senate is building a federal framework for stablecoins. By legitimizing digital assets and providing regulatory clarity, it de-risks the broader ecosystem for legacy financial institutions.
Which changes everything. JP Morgan analysts are even predicting that Bitcoin could actually beat gold in the second half of 2025.
Standard Chartered forecasts $200,000 by year-end.
It's wild. David Schossler from Van Eck is quoted in the sources saying Bitcoin is the, quote, risky cousin of gold.
Yeah, I love that quote. They belong to the same family of inflation-resistant assets, but they serve radically different functions.
And here's where it gets really interesting. Look at the irony here. Bitcoin was a decentralized cypherpunk currency created specifically to bypass the traditional financial system, right?
Middlemen.
Right. And today, in 2025, it's being bought up by Wall Street titans like Goldman Sachs and Morgan Stanley. The system it was meant to circumvent is institutionalizing it.
Because absolute scarcity has universal utility. But, if we're looking at the divide between the two, why hasn't Bitcoin completely replaced gold?
Well, right, why not?
We have to evaluate market capitalization to understand those differences.
Okay, let's look at the numbers.
Gold has a total estimated market cap between $20.8 trillion and $28 trillion.
That is a massive ocean of capital.
It is. Even at record highs, Bitcoin's market cap is hovering around $2.2 trillion.
So it's only about 8 to 10% of gold's value.
Right. And that disparity in liquidity depth explains the violent price action.
How do you mean?
Think of market capitalization like a body of water.
Right.
Gold is the ocean. When a massive sovereign wealth fund, a whale, allocates billions into gold, it barely creates a ripple.
Oh.
The liquidity pool is vast enough to absorb the capital without shifting the price.
Oh, I see.
But Bitcoin is a backyard swimming pool. When that same institutional whale jumps in, the water sloshes everywhere.
Right.
The smaller market cap means it requires significantly less capital to drive the price up, creating explosive growth potential, but it leaves the assets susceptible to terrifying drawdowns.
Yeah, I mean, we've seen Bitcoin drop 30 to 50% in a matter of weeks. The sources point out the historical 80% drop back in 2018.
Exactly.
So if a treasurer is looking for safety, how can they stomach an asset that might drop 30% in a single month? Doesn't volatility defeat the whole purpose of a safe haven?
Well, traditional institutions do demand predictability. They cannot afford to report massive quarterly losses on their balance sheets. But for a different class of investor, that volatility is a feature, not a bug.
A feature?
Yeah, it provides asymmetric upside. The prevailing theory is that if global fiat currencies are debasing at 5 to 10% a year, a slow-moving asset like gold might preserve your purchasing power, but it won't generate real yield.
Ah, so you accept the severe volatility of Bitcoin for the chance at a massive gain to actively outpace the debasement.
Exactly. And this difference in risk tolerance creates a clear demographic and institutional divide. Older institutions buy gold, younger investors buy Bitcoin.
There is also this ultimate trust gap that separates the two. Over 200 publicly traded companies now hold Bitcoin on their balance sheets. But do you know how many major sovereign central banks have added it to their official reserves yet?
Zero.
Zero, not a single one.
They are accumulating physical gold by the metric ton, but they will not touch the digital alternative.
Why is that? Just the volatility.
It extends beyond price into deep operational risk.
Yeah.
Gold requires a relatively simple security model, right? You place physical bars in a subterranean vault, put armed guards at the door, and it's secure.
While Bitcoin introduces massive cybersecurity risks.
Exactly. You have to manage private cryptographic keys. Unlike gold, it requires complex digital storage.
The sources mention the 2014 Mt. Gox disaster, where hundreds of thousands of Bitcoins just vanished from a major exchange.
Right, and that is still a foundational trauma for institutional risk officers. If a central bank mismanages its private keys, or a custodian is hacked, the asset is irreversibly gone.
Wow.
There's no central authority to call to reverse a blockchain transaction. Underwriting that kind of risk on a sovereign scale is incredibly difficult.
So we are looking at a $28 trillion physical anchor and a $2 trillion digital rocket engine. It's really easy to view this as a zero-sum game where you have to choose a side.
But modern wealth managers are looking at this through a completely blended framework. They aren't choosing one or the other.
Right. The Hudson Financial Partners report suggests neither asset should be a, quote, core holding.
They classify both as strategic satellites.
Yeah, they highlight their jet fuel portfolio. It's a 5% allocation to gold, a 5% allocation to Bitcoin, and the remaining 90% stays in diversified traditional assets.
And combining two highly distinct volatile assets with a traditional equity portfolio actually improves the Sharpe ratio of the overall holdings.
For those listening, the Sharpe ratio basically measures risk-adjusted returns.
Right.
Blending both improves that ratio because they hedge against entirely different things.
Exactly. Gold is the ultimate defense against immediate physical catastrophe. If global supply chains fracture or a geopolitical conflict shuts down international banking, a physical asset with zero counterparty risk provides immediate solvency.
But Bitcoin hedges against a different threat.
Right. It protects you from massive digital disruption and the relentless programmatic debasement of fiat currencies. It offers explosive growth potential on a borderless network.
So what does this all mean? For your portfolio, gold is the anchor and Bitcoin is the rocket engine.
Precisely. You prepare for the worst-case physical realities with gold while positioning for the digital future with Bitcoin.
We have unpacked a massive amount of structural finance today. Thank you for joining us on this deep dive into the 2025 safe haven landscape.
It's been a great discussion.
Just a reminder to you listening, always assess your own personal risk tolerance before diving into highly volatile assets.
Right? Institutional investment horizons span generations, but yours might only be a decade.
Exactly.
But before we close out, there is one final mind-bending scenario from the game theory side to ponder.
Oh, lay it on us.
We established earlier that foreign central banks are aggressively dumping dollars to stockpile physical gold, right?
Right.
And that currently, 0 major central banks hold Bitcoin.
0.
In a network governed by a mathematically capped supply, the first mover gains a monumental advantage. So what happens to the global financial world order on the day the first major sovereign central bank decides to quietly start adding Bitcoin to its official reserves?
Oh, wow. The rush for the remaining supply would be, it would trigger a scramble on a global scale.
It would be change everything.
Something to mull over. Thanks for listening, and we'll catch you on the next deep dive.
Until next time.
All this time, I've been holding on so tight, 'cause all that I do